Hey there, and thanks for watching. In this video, I'll be showing you how to use our value add apartment acquisitions model. Now, in this particular tutorial, I'll be showing you how to use it to assess an actual value add deal. So this hypothetical property we'll be looking at today has 250 units, and each one of those units is below market condition, and as a result, rents are below market. And so we'll be acquiring the property and then performing renovations on the units over a 3-year period. And as those renovations occur, the rent for those newly renovated units will be increased to a market rent. And at the end of our renovation period, we'll allow for some seasoning, call it 12 months, and then we'll sell the property. Now to do this, we're using beta version 0.13 of the model. You likely have a newer version of the model, and you can see what changes have occurred since this video here on the versions tab. There's also a summary tab, which we won't go over today, and all of our assumptions will occur here on this underwriting tab. Now, if you're familiar with this format of model that one type of model that we have at Ventures and CRE, all of our assumptions are in this underwriting tab, and they're organized sequentially from investment cash flows, right? Your time zero cash flows in the case of a traditional DCF. In this case, we'll have some negative cash flows as well as we renovate the property. But basically in our DCF, these are those negative cash flows. We'll also be modeling out our capital stack here. Then we'll get into operating cash flows, and that is what is next as you scroll down the underwriting worksheet, followed by reversion cash flows. And once we've entered all of our assumptions, we can look at our returns. Now, you can either scroll up or down to access each of these sections, or at the top here, we have a navigation bar with buttons where you can click and move between sections like so. Okay, let's start at the description. And here, the hypothetical deal, and you can open up the assumptions for this particular exercise within the blog post. I'll have a link where you can download these assumptions. I'm just going to pull them over to my second monitor and get started. So Charles in Charge Apartments is the name of our hypothetical deal. It's located at 555 Main Street in any town, any county, any state. Any state, any county, zip code is 5 zeros, any city. Property is 19.5 acres. There are 17 3-story buildings. There's no structured parking. There are 412 surface parking stalls. Our analysis will begin January of 2020. And then our sale will occur 12 months following completion of renovation. And so I'm just going to enter a formula here under sale month. Right now it says month 38. I'll say equals. And I'll come down and find under operating cash flow complete roll. This is when we complete our renovation. That's in month 32. And then I'll just say plus 12, such that month 44 is the sale date for our analysis. Then we move into investment cash flows. Now here we have our investment cash flows. Really, it's our project budget. It's broken up into acquisition costs, which include a purchase price, some closing costs, and anything else, maybe due diligence costs or have you, that we might include under our acquisition cost section. And then we have hard costs, soft costs, and financing costs. Well, I made this fairly easy. I just have a purchase price, $36 million, with closing costs before financing of 0.5%. So I'll go equals, take our purchase price, multiply that by 0.5%, or 180,000. And then it says that will all occur in time zero. So we come over here, and this is how we forecast the cash flows. These will start in month 0 and end in month 0. The forecast method is straight line, but since it's all occurring in the same period, it really doesn't matter which method we use. And the result is 36.18 million will be spent in time 0 to acquire the property. All right, then we move to hard costs. And we'll just leave this as renovation costs. And we were told that we'll be spending $12,000 per unit in hard costs. So I can go equals $12,000 multiplied by the number of units. And there's two ways we can do this. The first is we know there's 250 units, so we can just multiply that by 250. Or if we want to make this dynamic to the number of units, or perhaps we change the number of units or whatever, we can go 12,000 times, and then we scroll down to our unit mix table. Here it says number of units right there. Hit enter. Or an even faster way, I have created a name cell called units. So we just go 12,000 times units, 3.6 million. Now we're told this is forecasted over 24 months. So starting in month 1, ending in month 24, on a straight line basis, we'll spend this 3.6 million. And you can see it out to the right, starts in month 1, ends in month 24, and the sum of all of those cash flows is 3.6 million, or 150,000 per month for 24 months. Then we move to soft costs, and we really only have one line item. We'll just call it soft costs, and these will zero out there. And we are spending $2,500 per unit in soft costs, or 750,000 total. And again, that's over 24 months. Also straight line comes out to 31,250 per month. Now next, we have financing costs. And what we're told is at closing, or in time 0, we'll spend 1% of the senior loan amount and 2% of the mezzanine loan amount. So this is a fairly easy formula. We go equals, we come down to senior loan, right here, senior loan amount times 0.01 plus the junior loan amount, which we'll rename mezz loan in a second, times 0.02. Oops. And that creates a circular reference, which we don't want. So for now, I'm just going to leave this blank. I'll highlight it yellow to remind myself to come back to it. We'll find out how much the senior loan amount is, and then we'll just manually enter that here under financing costs. So next we learn, we'll get to the capital stack. So the model includes up to 4 capital sources, 2 equity, 2 debt. And so in this case here, we have first to fund is the senior loan. And so I'll enter funding order 1 for the senior loan. And it is 70% of the purchase price. All right, so what's 70% of the purchase price? Well, it's equal to 0. Oops. So, and the input is loan to cost. And if we look at the formula, it just simply takes the total uses, inclusive, right, of hard costs, soft costs, and financing costs, and it multiplies it by our loan to cost over here. So we need to figure what loan to cost would result in a loan amount that is 70% of the purchase price. Well, we go equals, we scroll up to the purchase price, 36 million. We multiply that by 0.7, and we divide that by what? Our total uses there. Okay? Or 62.2% loan to cost, 25.2 million. Now our junior loan flows, let's see, it funds third. So enter 3. And it is 10% of the total project cost before financing. So this one is equal to the total project cost before financing there times 0.1 divided by total uses. Or that's roughly, well, that is 10% of total uses for now. Now we're going to add financing costs right now, and it will be slightly less than 10%. So let's come back up here to financing costs. And again, this is equal to now 25.2 times 0.01, oops, 0.01, plus, and this one, yeah, 4053 times 0.02. All All right, 333,060. And now you see that the mezz loan, let me rename this, is roughly 9.9% of our total costs. And so then also in our capital stack, second to fund is both the GP and LP equity, and they fund pari passu, meaning at the same time, in the same order. So they're 2. And the GP is 10% of the equity. The LP is 90% of the equity. And what we get then, if you come out here to the right, is the senior loan and some equity funds the acquisition in time 0. And then in month 1, equity funds, and a portion of month 2, the equity funds the beginning of the renovation. Once the equity is contributed enough where, or the entire amount required of the mezz loan, the mezz begins to fund, and it funds from month 2 through the end of the renovation period. And so in month 24 is when the mezz loan has fully funded out. And now we get then total sources, the combination of those 4 tranches of debt and equity equal our total uses, which is the sum of our acquisition costs, hard costs, soft costs, and financing costs. Next, we move to just some of the terms for our loans. So we see that the senior loan has no IO, and it's amortizing over 30 years, 360 months, and it has a term that is equal to the analysis period. So right now, by default, the term for the initial funding of our senior loan and our mezz loan is equal to the analysis period. And that's just by default. Now, if for whatever reason it's changed, you just need to come in here and change this formula to be equal to that cell. All right, and that cell is named analysis_period. So we just copy that down. Then in terms of rate, both are fixed. So I'll change the rate type to fixed. And the senior loan is a 4.5 rate and fixed rate, and the mezz loan is 6.5. Now the mezz is all IO, so the IO is equal to the term, and the amortization period doesn't matter here because it's all IO. So we have finished then our investment cash flow section. Let's now move to our operating cash flow section. So what we see is we have a growth rate for all line items of 2%. So we'll just set all of those to 2%. Our roll assumptions are, okay, starting in month 3, our units begin to roll, and they end rolling in month 39. And the thinking here is there's some lag from when units are renovated to when they've fully hit a market rent. And this might be overly conservative, but these are the assumptions we're using for this exercise. Now, something else you'll notice is there's the option to do a custom roll. And here, rather than using this begin roll, end roll concept and basically straight line your units are rolling to market, you can come out here to the right. And right now it's using that month 3 start, month 39 end to show you the percentage of units that have rolled. And immediately below that, you see a line, the status of the units, whether they're in place, they begin to roll, and so it says rolling. And once they've fully rolled to market, all 100% of units are market, this says renovation ends, and they're now market. And they're market through to the end of our analysis period. So if you set this custom roll to yes, you can come in here and change these values, the percentage of units that have rolled to market, to whatever makes sense for you. In this case, I'm just going to leave this no, just have those roll straight line to market. We can still see, though, the events when the renovation starts, month 3, when the renovation ends, month 39. And then up above, we have just some operating metrics: expense ratio, utility reimbursement percentage, effective rent per square foot per month, and economic vacancy. So with that, let's move to our unit mix table. There's 3 unit types. So everything below I'll just set to 0. You really only need to set the number of units to 0 and it will flow through to the rest of the model. But just to keep this looking clean, I'll actually enter those as 0. And we have studios, 1 bedrooms, and we have 2 bed, 2 baths as well. There are 60 studios, 150 1 beds, 40 2 bed, 2 baths. Average square footage 600, 750, and 950. None of the units have been renovated to date, so leave those as 0%. And in place, 900, 1200, and 1500. So that's our pre-renovation rent for each of these unit types. Post-renovation rent, we're going to bump our studios to 1150, our 1 bed, 1 bath to 1500, and our 2 bed, 2 baths to 1900. That's a pretty big pop. And so we see our rent per square foot is $1.58 currently, and we're going to take that to $1.98. Which that's quite the increase, but that's what we're doing. This is hypothetical. And here you can see, and this is untrended, so ignoring growth, in place is stabilized. We're in place at 3.528 million of potential gross rent. Stabilized potential gross rent before growth would be 4.44 million. Now next, there's no concessions, either pre or post reno, no non-revenue or model units pre or post reno. So to zero those out. Now the next thing that we have is in place, there's no RUBS program. So we're not charging back to tenants for utilities. And currently we're earning, let me look at my notes here, $25 per unit per month in just miscellaneous income. All right. Now, post-renovation, we're going to implement a RUBS program and bring in $30 per unit per month. We're going to take miscellaneous income from 25 a unit to 35 a unit, zero out any other income line items. And now you can see we're going to take other income from $75,000 a year to $195,000 a year. Now, the next thing we have is vacancy. Leave this 5% both pre and post reno. Now, this is standard. What that means is it's just 5% and it's straight line increasing from, let's say we went from, I don't know, 5 down to, let's say we went from 8 down to 5. That's going to happen straight line, but we could actually detail that. And when you detail your vacancy, then up here, the detailed vacancy line item appears. And right now it's just, like I said, straight line. But you can come in and actually set your vacancy by month. So if for some so let's imagine you wanted to get specific about certain months of the year where you have maybe more vacancy than other months, and you wanted to really dig into that, you could do that with that detailed vacancy line item. In this case, though, we're going standard, leaving these at 5. Next, we have our operating expense assumptions. We're assuming really that they're the same pre and post reno on a per unit per year basis, with the exception of property taxes, where we'll be sizing property taxes to some mill rate that we feel is market. And so R&M, 300 per unit per year, payroll, 1,100 per unit per year, admin 250 per unit per year, marketing at 300 per unit per year, utilities is 800, contract services 150, make ready costs at 200, management fee 3%, insurance at 175, and then we're solving for a 1.25% mill rate. So here, let's say 2750, almost there. So what about 2700? Almost. How about 2725? That gets us to 1.25%. So now you see then that our operating expenses are slightly higher once we've renovated the units because property taxes will go up. But otherwise, we expect our other operating expenses to stay the same. The pop in NOI then goes from $2 million to $2.7 million based on those changes. Now, capital reserve $200 per unit per year, so that's fine there. And let's just finish by going to our reversion cash flow assumptions. Now, we think that market cap rates for the building as if it was fully renovated today is 5.5%. And we think over the 4-year hold, cap rates are going to increase, both as a result of the property becoming 4 years older. So while we're renovating the units, its age is still getting older. And so in the minds of the market, it's an inferior product 4 years from now than it is today, all else being equal. The other thing is we expect some increase in rates in the market that will have an upward pressure on cap rates. And so we're going to assume 50 basis points an increase in our cap rate over the hold to a 6% terminal cap. We're going to assume a 2% selling cost. And then we can see then our valuation in place, stabilized, and this is now trended. So when we look at a stabilized value, that assumes that 2% growth over the, I think it took us 39 months to get to stabilization. So we get to $49.705 million. And our sale in what month were we selling? Let's see. Month 51. So as of month 51, at a 6 cap, 2.982 million NOI gets us to a $49.7 million sales price. Subtract out the 2% selling costs, we get a net sale proceeds of $48.7 million. We pay off our senior and mezz loans. $27.319 million are the payoff at that point. That gives us equity proceeds of $21.392 million. And we can see the returns then at the property level. Net unlevered, 1.5 equity multiple and 11% IRR. And then on a levered basis, it's 2.24 times equity multiple and a 22.47% IRR. We also see then our development spread, which while this isn't a development deal, what we're really interested in knowing our yield on cost, right? That's our stabilized NOI untrended divided by our total project cost. And we want to understand the delta between that and that market cap rate today at 5.5%. And we see it's 140 basis point premium that we're getting. And that's a healthy premium. That tells us that this is a value add deal worth doing. So we see at the top then just a quick summary of some levered return metrics. We can come back to the summary page though and get more details, key assumptions and return metrics in this section. We didn't talk about partnership returns in this tutorial. We'll do that in a subsequent tutorial. But here we have just some basic property level cash flow charts where you can see cash flow after financing growing, NOI growing as the capital improvement plan goes into place, as rents are marked to market. With that, I've created, I guess, the second tutorial for our value add apartment acquisition model. Let me know if I missed something or if you have any questions. Otherwise, thanks for your time.